In this video, we'll learn you how to correctly read a trading chart. We'll show you how we read charts and take high accuracy trades. Let's understand this with an example. Look here, the price was moving down, forming lower lows and lower highs. So during a downtrend, we only look for selling opportunities. At this point, we'll connect the highs to form a trend line, which will act as a resistance. Next, the price comes near the trend line and forms a shooting star candlestick pattern. The next confirmation candle opens with a gap down and closes lower. If we take a sell entry here, we can place our target near the next support zone and our stop loss slightly above the high of the bearish candle. But even if the price moves in our favor and hits the target, the risk-to-reward ratio might not be good. We may not get even 1-to-1. There's a probability that price may fall, but since the risk-to-reward is not favorable, we'll avoid this trade. Next, the price drops to the support zone and then starts moving gradually upward. The price breaks above the bearish trend line and even breaks the recent swing high, which means the downtrend has now reversed into an uptrend. If you look closely, you can also see a double bottom pattern forming here. Now, we can start looking for buying opportunities. Next, the price pulls back to the trend line, which previously acted as resistance but now acts as support. At the trend line, we get a bullish candle signal. This is our buy entry point. Our profit target will be near the next resistance zone. Normally, we place our stop loss below the candle's low, but in this case, we'll place the stop loss slightly below the support, because sometimes the price comes down a bit to grab liquidity before moving up again. Even after keeping a slightly wider stop loss, we can still get around 1-to-2 risk-to-reward ratio. The price moves upward and our target gets achieved. Later, we get another shooting star and confirmation candle, which means there's a possibility of a short-term decline. But remember, earlier during the downtrend, sellers were in control. Now, in this uptrend, buyers are dominating. So even though we have a bearish signal, we'll not enter a sell trade because the trend is bullish and buyers are stronger. Next, the price drops slightly to the support zone. If you had taken a sell here, you might have made a profit. But remember this, trading against the trend may work once or twice, but most of the time it leads to losses. So no matter how strong a candlestick pattern looks, never trade against the trend. Now, the price is again near support, and we've got a bullish confirmation candle. Since the trend is bullish, we'll go long here. We'll set our target near the resistance and place our stop loss slightly below the support. Not too tight, but with some breathing room. The price moves upward, and once again, our target is hit. But notice, before the major upward move, there was a small red candle that dipped down. If we had placed a tight stop loss, it would have been hit, and we would have missed the big move. So remember, don't keep your stop loss too tight. Give it a little space. Now, let's connect these two swing lows to draw a bullish trend line, which will act as support. In this trade, you could have achieved around a 1-to-3 risk-to-reward ratio. Next, the price slightly drops again near the trend line, and we get another bullish confirmation candle. That's another buy entry, stop loss just below the bullish candle's low, and target at the next resistance. Since the trend line is supporting and the trend is bullish, this trade is valid. Once again, our target is hit. Later, price comes down again. The old resistance now acts as support. We get another bullish signal, but this time the confirmation candle doesn't close above the bullish candle's high, so we'll avoid this trade. If it had closed above, we could have taken a buy. Overall, we took 3 profitable trades with good risk-to-reward ratios and avoided 2 trades, one due to poor confirmation and one due to poor risk-to-reward. Now let's discuss an important theory. During a downtrend, people believe that the market doesn't respect supports and keeps breaking them. Similarly, during an uptrend, they say the market doesn't respect resistances and keeps breaking them. That's the theory. Look back at our previous chart. When the market was in a downtrend, there was a support level. According to that theory, the market should have broken it. But that didn't happen. The market respected the support and moved up. That's why never ignore support and resistance levels, whether in a downtrend or uptrend. Earlier, we avoided taking a trade because a support was nearby, and later, we avoided another because of a resistance. You might feel regret thinking, if we had bought there, we could have made a profit. But remember, by respecting support and resistance, we saved our stop loss from being hit earlier. Missing one trade isn't a big deal, because sometimes we save a loss, and sometimes we miss a move. The key is to take maximum trades that avoid stop loss hits. We already got 3 profitable trades, so there's no need to regret the missed one. This is how you should read charts calmly and with patience. Look at this chart. You can't understand anything clearly. You don't know which level is important, what the market structure is, or whether buyers or sellers are stronger. When you see such a chart, avoid trading. Because the first rule of chart reading says, if you can't read it clearly, don't trade it. If you can't understand the chart, you'll definitely lose money. So only trade charts that you can easily read and interpret. Finally, here are a few tips. 1. Identify the trend first and trade with the trend. 2. Then, mark important levels. 3. Wait for a candlestick confirmation signal. 4. And never ignore any chart pattern formation if it appears. Hope you like this video. See you in the next one. Until then, bye.